Hey, everybody, welcome to the live stream. It is February 19th. Stock market has closed. I'm looking at the market, seeing what happened. We didn't have a clear direction of what the heck's going on and where the heck the market's going to go. But we can look at a few areas that did work today. We'll look at some individual stocks. It looks like I've got a couple of requests. CODIS CAD already put Hafnia or HAFN on the board. So we'll take a look at that. And then Omar put WS. So we'll be sure to handle those. Now, before I do that, I wanted to go over the market and kind of give you some opening comments. To begin with, the market opened in the green. Very good to see that we had the stock market go up just a slight bit. And the market is nudging up. Now, it's not breaking any records. It is breaking records, all-time records, but the rate of appreciation is not all that impressive. It's just kind of muscling up. So that is interesting. And on the NASDAQ side, it's also somewhat going sideways. It's up 3.86. On the Dow, it's up better than the other two. It's also flattened out. Started the year nice, and then it flattened out. And the Russell, what's going on, Russell? It's up the least amount, and it's also flattened out. So that type of movement, lack of momentum, makes me feel a little nervous. Like, hey, stock market's not pushing up. We've had the big earnings come out. We have a couple left that are pretty big. NVIDIA is probably the biggest one that's left. We have some others, like we have BABA later this week. We've got some good ones. But it is also a time when it's we're in a market that has really appreciated really nicely for quite a while. And if we look at the rearview mirror, man, things look great. S&P's up 71.48% since October of 2022. So in call it 2.5 years, we're up 71%. That is great. That just isn't something that's going to be sustainable. If we look at the max chart, the market, in the 2000, there was a dot-com bubble here somewhere. It's already flattened out. The numbers are so staggering now. So we've seen the market really go up and really attract a lot of investment. Now, it's very good if you are investing through this whole time, which I have been. It's great to see assets really go up in value. But I'm just thinking there's going to be an end to the party at some point. So I'm not going to get out of a majority of my stock positions. But as I've shared with you before, I'm going to keep building cash, just taking dollar cost averaging out of some of my positions, some of my winners, and just build up that cash so that when we get another correction like the one we got in 2022, when the market just sells off, the S&P sold off by more than 24%, I've got some cash. I've got cash to, take care of that. And I do carry a pretty good portfolio of bonds. And that's always good because bonds are a hedge against stocks. And I'm going to also add some bonds. So I'm going to be increasing cash, buying into some bonds, just making sure that at some point when the market corrects, I've got some cash to work with. I'm not hoping for it, but I'm just being realistic. The market is not going to go up forever. And at some point, we're going to have to give up some of these gains. We're getting some valuations that are just nuts. Let's start with Palantir just to look at it. This stock has just gone nuts, right? Boom. And for the past year, it's up 378%. You're paying more than 100 times sales, or people that buy Palantir are paying more than 100 times sales. That's crazy. You don't they don't have enough cash to even register. You're making like 0.4% free cash on a share of stock. So you're getting valuations like this. You're getting valuations like this, where HIMSS is up 615%. Look at this parabolic move. It's like, man, this is freaking nuts. I'm going to pick on some of my own stocks. You got Robinhood. I own Robinhood. This is insane. The stock going up 320%. So would I love for Robinhood to go up at this rate? Yeah, that's great. But I didn't expect it was going to go up that fast. I knew it was I think it's a good business. I think it's a good company. But I must admit, this is a lot of frosting on the cake. So just building up my cash position, putting that out there. Not meant to talk anybody into doing the same. I'm just sharing with you what I'm doing. I invest a pretty sizable chunk of money, and I want to increase the value of that money, build my wealth, continue to make it bigger, larger, and just grow it. I've got a personal goal, and if I can hit that goal, that'll be awesome over time. Looks like we've got more people joining the live stream. Thanks for joining. Looks like Shadwick. Good evening. So looking at Walgreens. All right, let's take a look at Walgreens, and we'll do a head-to-head cage match between Walgreens and CVS. Ultimate fighting meets stock investing. Sergio, what's up, man? Thanks for tuning in. Sabir, great to see you. Jay Zev, how you doing, man? Thanks for joining. And if you guys want to see some stocks, looks like Jay Zev read my mind. Pfizer and Merck. Yeah, let's talk about those, man. So Pfizer, Merck. Man, Merck's been getting a lot of flack. So we'll take a look at those two. So, all right, let me carry on with kind of an opening session that I wanted to do. Just real quick, the heat map. Where was the action? Where is their money being made? Healthcare did quite well. Energy did well, and consumer staples. So that was kind of like very consistent green in these areas. Even utilities had a little red. And you could continue to see that the big tech stocks, there's been a few days when it's all green. Looks like Meta gave up some more gains 2 days in a row. It had gone 20 days of consistently trading and closing higher, which was great. But now it's 2 days of it selling off. We'll see when it ends. Hopefully it doesn't go 20 days to the negative. And Meta is my biggest position. That would be terrible, but hopefully that's not the case. Amazon was flat. Nvidia traded down a little bit. Apple is kind of flat. Apple announced that they're going to have a less expensive phone that can run AI, and we'll see. So, Sergio, you want me to talk about Bumble, right? Yeah, we'll talk about that. I'll cover that because I did release the video earlier today. Is basically a recording of our live stream yesterday, but it was interesting how bad that dropped. We'll take a look. All right, so the heat map showing that and I want to get to this right here. So the heat map showing that let's take a look at the 1 day here. Healthcare kind of won the day. Consumer staples was there. So these sectors stayed in the green. Materials, it did the worst. And the others didn't lose too much. And we'll go year to date. Who's winning the race here? Communication services still out front. Separated themselves a little bit from materials. Financials is catching up. Utilities is still there. And then there's kind of all these players in the middle. It's good to see that all sectors are doing well. I think that some money is rotating out of technology. It's so big. It's 22.38 trillion. The closest, sector after that is consumer discretionary at 8.8 trillion, and then healthcare at 8 trillion, and then communication services. So this is such a big sector. If money rotates out of it, it could really impact another sector, other stocks that have lower caps. The big caps year to date, we're looking at, it's a little bit like Christmas, right? You got red and green, red and green. Apple's still down for the year. Microsoft's still down for the year. Google's down for the year. Tesla's down for the year. So we're seeing some red out there. You're seeing some of that rotation. Investors are saying, hey, let me take some of this money off the table. This will be the biggest news. And I'm going to get this guy ready to review later. Okay, so that's what's going on in the market. We have some earnings that are happening. These are not massive earnings. We can look at like Carvana later, but these aren't like stock market movers. These are just good companies, good, interesting companies. Yesterday we had similar, where you have these companies, and of course, if you're an investor in these, of course they're important, but they're not going to move the market. Tomorrow, Walmart could move the market. I think Walmart, in a way, not only is it a massive cap, but it kind of gives us a bird's eye view of the economy. What's the consumer doing? And it is rear view mirror kind of data, because they're reporting a quarter that probably ended January 31st, because they have the retail calendar. Baba, I'm expecting good things there. Booking, they're probably going to do well, but they're probably going to guide with some caution. Mercado Libre, really looking forward to that. So this is going to be a big day tomorrow. And in the morning, we'll get to digest Walmart, Alibaba, NetEase, if you're into that Chinese company. Those are the biggies. And then after the market closes, we'll take a look at bookings, Mercado Libre, new holdings. Hoo-hoo. Let's go, new holdings. Newmont is going to report after the market closes. So tomorrow will be an interesting day. Yeah, there's a lot of stuff going on tomorrow. So tomorrow will be big. So that's what's happening out there. All right. So let me catch up on comments. And then we're going to start looking individual stocks. Can I check symbol S? Yeah, I'm not sure what that is, but I'm going to check it out. Yeah, we'll take a look at Bumble. That was quite a drop. Let's take a look at Super Microcomputer. That's a dumpster fire. And we'll take a look at it. Good to see you, Brian. Thanks for joining. And then Sabir, TTD, and S. Okay. All right, let's get going with HAFN. Hafnia Limited owns and operates oil product tankers in Bermuda. It operates through Long Range 2 and Long Range 1, medium range. Okay. So it transports clean and dirty refined oil. So it has these ships that are moving oil around. Now, oil prices have been kind of tame. They haven't been like cranking up. And so moving of oil is probably just as good, but I just wanted to note that the oil prices are pretty tame. This company, they have a humongous dividend, but for the 1 year, they haven't appreciated. Investor might be happy that, hey, they gave me 26% dividend. I'm good. Over the 5 year, look at that, up 218%. So whomever invested early did really well. Okay, it's a $2.55 billion market cap company with revenue at 3 billion, net income of 870 million. That is excellent. On their market cap, that is such a high rate of return. You're talking about like 30 some odd % rate of return on net income. That's phenomenal. PE for the current year, 3, forward PE 7.46. Strong buy, discounted by 61%. What's wild is they're that profitable and the stock doesn't work. The market doesn't really treat shipping companies with a lot of love. It's usually like the stocks rally because it's just obvious these guys are making so much money. Like at one point, Zim had their dividends were like 40% of the stock price. So if you bought a share of stock, they gave you back 40% in the first year. And then the second year, they gave you like 25% back. Within 2 years, you were like, man, I'm almost got back all my investment. That's how much money they were making. In this case here, it looks like these guys are also raking in a lot of money, probably because rates are nice and high. These guys are going to announce on March 3rd. So we don't have anything super fresh on the data side. Let's take a look at the financials. So the stock's been coming down, but look at this green on the screen. What is the deal? What's the deal, stock market? Looks like they grew from 21 to 22 by adding ships. That makes sense. They've had some boom years. Look at that. And good growth. We look at the quarterly. It's still growing. Last quarter grew by 10%. They're getting bigger. 3 billion is really a good sized company. So that looks good. Gross profit looks good. Let's take a look at the percentages down here. Free cash flow looks awesome. 938 million. So the market cap's roughly 3 billion, right? No, 2.55 billion. They have $938 billion of free cash. So they're basically about 35% free cash flow. So gross margin of 38%, profit of 28.65%. That's great. Free cash flow margin, 30.88%. That's phenomenal. Awesome. Their free cash flow per share is $1.82. So those numbers look great. So when we compare $1.82, they can afford that dividend. So they can afford this high dividend if they want to keep paying it. And they're producing a lot of free cash. Now, when we look at the forecast, 2 analysts look at this stock, and one says it's a $10 stock, one says $6.50. It's only 2 analysts. Down here, we've got 10 analysts that are providing this forecast. When we look at the forecast for 2025, revenues are supposed to come down. But this is weird because I think revenue is operating above this number. So these numbers may be a little too inaccurate. So, yeah, I'll have to double check those numbers. Not enough analysts are covering the stock to make me feel comfortable with those numbers. Nonetheless, I think this stock, it's about with shipping, it's about knowing when to buy in and knowing when to sell. Like when you buy the stock, you have to also have a good plan to get out, because these stocks will go up and they'll come down, go up, come down. That's what this guy's doing, going up, coming down. Now, is this going to be a good period maybe for the next couple months? Potentially. These here, if you look at Zim, Hafnia, and then we looked at SBLK, their fundamentals look really good. Now, this is a nice dividend. And where are they located? Let's see here. The reason I ask is like Zim is located in Israel, and these guys are located in Bermuda. And I don't know what the tax rules are with Bermuda. Like, do you get taxed and so forth? I know that when I was getting my dividends from Zim, the country of Israel did put a nice little tax on me, which took some of my dividend away. So it'd be good to understand, what is Bermuda going to want? Are they going to want anything? Are they going to want a little bit of tax? I don't know. All right. So this one here, it's your call. Like, if you feel optimistic about their business, you could substantiate the stock price. No problems. No argument out of me. And you have good choices in shipping. The oil business, I'm unsure. Oil prices are staying low, and with low oil price, or oil producers, really eager to pump out more oil and ship it around the world. I don't know. So this one here, I'm going to stay out of Hafnia, but I think that it's a really valuable company, and it's your call. No short sellers in the stock. That's good. Balance sheet, they have $197 million of cash, about $1 billion of debt. Debt to EBITDA is 1. So they're good. Balance sheet's very good. So Hafnia looks good. Zim looks good. SBLK look good. Those are 3 shipping stocks, and three different types of shipping stocks. Hafnia will transport oil and other types of liquid products. SKLB, dry cargo, like aggregates and kind of materials in their types of ships. And then Zim will transport the big containers that are oftentimes loaded up with products from China and shipped around the world. So take your pick. Shipping is out there. The other thing that you got to think about is the economy, right? I think tomorrow Walmart's going to announce, and we'll see where their head's at with regards to the economy. If they guide where they're like, hey, we think the consumer's going to play it safe, and we're seeing that, the consumer's going to buy less, that's probably going to send shipping stocks like at least Zim down, because there's going to be an expectation that demand on products is going to be lower. So that'll tell us a little bit about the consumer tomorrow. So that is Hafnia. Man, that dividend looks really big, but they can afford it. These are, when I invested in Panel. Let me take a look at that one real quick. And so these guys, I invested back here, and I made a really, really, really good return. And then I sold and have been out of Panel, and I've been in Zim, and they've sold off. But you see that upward chart, beauty. And now they're 336 million. When I started buying into these guys, they were like 50 million in market cap or so. And these guys are like SK Starbuck, which is SBLK. And these guys, I did really well with them. They had a nice dividend, little company, but they have like specialization, especially around the northern routes of shipping product, and they ship those aggregates. So these guys, I got in, I got out, made good money, and moved on to Zim, made money. Now, right now, I don't have any shipping stocks, but you got to kind of look at the economy and kind of make the best guess that you can make out there. And it's surprising it's only 75% rise. I could have sworn it was much better than that. Yeah, if you sold up here and you bought at $2, yeah, you're doing great. Because I sold like around here, and I was buying here. So I did well. All right, so that is the shipping industry, with Hafnia being the primary stock we looked at. Now let's take a look at Worthington Steel. This one I think is for Sergio. And these guys produce steel that is flat rolled and delivered to automotive and a number of companies that take that material and then turn it into a product, heavy equipment and so forth. These guys are really small cap, 1.47 billion, revenue of 3.29, and forward PE is really low. Analysts think it's heavily discounted. Dividends pretty decent at 2.2. Over the 1 year, it's down, but it had a nice rally, maybe around the election. And then it came back down. Wonder why it came back down. Now, the tariffs may help a company like this. If they're a domestic producer, they're located in the States, I mean, they'll be given an advantage because their competition is going to be priced higher because these guys are going to be protected if they're in the US. Revenue is coming down, not a whole lot, but it's coming down. It came down in 2023. So that is a concern. Yeah, it's been down for 2 quarters in a row. So that's concerning. Why can't they get their revenue to grow? It might be the commodity is down, that just doesn't cost a whole lot. Maybe tariffs are going to help them. Free cash flow's there. That's good. Not a whole lot of it, but it's there. This is a small cap. So gross margin, not really great. They are profitable. So these guys are processing the steel. Yeah, these guys, in my opinion, it's tough to do an estimation because their free cash flow is not really consistent. You see that it's gone 123 to 3, 269 to 96 to 79. So what's going to happen next, right? Is it going to be 80? Is it going to be 100? Is it going to be 50? If we took 80 times 10, we get to about 800 million, which is lower than their market cap. And that's what I would multiply it with because this industry is not really desirable. They don't make a lot of money. The margins are low. It's cyclical. There's a lot of undesirables around it. They have about $135 million of net debt once you deduct that cash. And debt to EBITDA is 0.68. So not too much debt, excuse me. There's one analyst that covers this, and he thinks it's 38% discounted. I don't know. I don't know if I agree with that. I think if you're betting that tariffs are going to really help this company, well, then you're investing on a story. Okay. I can understand that. But if you're investing on fundamentals, the cash isn't very good. It's not consistent. They're losing, sales. Their revenue is contracting. That's a big concern to me. So I would stay out of WS unless you are really bullish that hey, if the tariffs help these guys are going to double in value. Okay. Well, that would be a story. That'd be why some investors might invest. But I'm not taking that for a ride. So that's WS. The fundamentals don't look good. They might be in the right industry given the tariffs. And those are my comments on it. Good luck with it. All right. So we covered HAFN, WS. Let's keep rolling and talk about Walgreens. So Walgreens has kind of been a basket case for a while, and it's down 80%, 79%. And it's really, talk about consistency. It has consistently gone down. And they just can't get their business, really to go. Market cap's $9 billion. Revenue is $150 billion. Think about that. We just talked about early in the live stream. I talked about Palantir being sold at 100 times their revenue. These guys are being sold for a fraction of the revenue. They have $150 billion of revenue, but they're losing money. Their forward P is 7. Wow, that looks pretty ridiculous. Ridiculously good. Year to date, they're up. Over the 1 year, they're down. So they had a really nice earnings and they really popped, right? They went from $9 and some odd to $12.93. Wow, that was a nice rise. Analysts think it's discounted by 22%. They keep growing their business top line. That looks good. When we look at free cash flow, negative, and nothing available in the trailing 12 months. Gross margins are low. And here, Walgreens might be like a short-term trade in my mind. Like, hey, if you think it's going to start working and maybe the stock goes from $10 to $20 and then I sell, maybe that's the move. But I'm not really interested in that. The company that I am interested in investing in, and I continue to buy, is CVS. I think CVS gives me good long-term value and good short-term value. Near term, it's up 47%. Long term, it's not as bad as Walgreens, but I think once you look at the fundamentals, these guys are $83 billion, but they're $370 billion of revenue. Forward P is 11. Dividend is really good at 4%. They continue to grow their business, and it's already a gigantic business, right? We're going to see that Walmart is going to announce tomorrow. And let me open up Walmart just to have it. Wanted to see what their revenue was. So their revenue is $373 billion, which is gigantic. But CVS is $370. That's gigantic too. Not quite, Walgreens or Walmart, but this is massive. And when we look at these guys, historically, they've just been a money cash generating company. This cash generation was like epic. And I think they're going to get back to 10 billion. Even if I use this number, I think that CVS is discounted. But when we looked at Walgreens, it was like a dumpster fire. They had no free cash. It was negative free cash. Just a lot of problems. And this is retail. We had Rite Aid go bankrupt, and Walgreens may end up, in that type of situation because they have a lot of problems, where CVS, less problems. So I highly favor CVS. I continue to buy shares. I think it's discounted. You can check my channel for videos on CVS. Got plenty of them, but I believe that it's still discounted. I continue to buy shares. It's working really well. I think it's the number 2 stock in my portfolio from an appreciation percentage perspective. Number 1 is Robinhood. Number 2 is CVS. And others, notable names are like New Holdings, Meta. But this one is getting it done, man. And I'm really excited for them because this stock has seen better days. They can get back to their $100 price, most definitely I'll double my money. I'll be very happy. And I think they could probably go up to $100, $200 per share. If their business is fixed, their competitors are really leaving the market. These guys do, of course, pharmacies. A lot of product they sell is retail price at a good margin. They sell like makeup and snacks, some food items. So it's a pretty good stock. And what are they listed? They're listed as a healthcare, but they should be listed as well as a consumer staple because they're a little bit like a grocer as well. So I really like the CVS business, far better than Walgreens. I think Walgreens has plenty of problems to try to fix. They had a new CEO a couple of years ago, didn't work out. They're going, they're on the second CEO. I don't think, the A players want to work at a Walgreens. They think it's kind of a big problem company, and they probably can't get the talent to get them out of all the stuff that they're in. So those are my comments on Walgreens. It's not a stock that I want to invest in. I'd rather be in CVS. I'm getting a way better performance short term, and I think it's setting up for a really nice long-term rally. Go CVS. Go make me some money, CVS. I like stocks that make me money while I sleep. I get up in the morning, the stock's up. All right, cool. I made money while I slept. That is the kind of stock I want. So that's Walgreens, Combo, CVS. Next one we're going to head to is Pfizer and Merck. Before I do that, let me check the chat and everybody who's joined. Thanks for joining. Man, we got some people coming in, and we're doing some deep dives on some stocks that people have requested right in the middle of it. And if you have a stock you want to look at, please put it in the chat. Sergio, you're thinking of buying, start buying every big dip on famous known companies. I would say, pick the ones you want, and it's good to do your homework in advance and then be ready. Yeah. I mean, it's not a bad idea if you see these stocks come down. Now, the one I would pick out of this list and say, this isn't a great company is SMCI. We're going to go over that later. I would not mix it in with the list that you provided there. Agreement on Meta, Netflix, Spotify. I would argue CrowdStrike, and there's better options for me, but it's still a pretty favorite to a lot of people. But Super Micro, I would not put those in a very good company list. Yeah, I mean, if you want to play it, if one thing I would recommend, Sergio, is study the most valuable companies, right? Understand, okay, why did Apple get so valuable? Why did NVIDIA get so valuable? Try to understand, what was their recipe to get that big? And then go find companies that are smaller caps, newer, that have those attributes that, hey, they produce a lot of free cash. They have high growth. They very dominant in their industry. They just have a lot of the same kind of characteristics as those really valuable companies. And that's where the big money is made, is when you can find, Apple at one time was $100 billion market cap company. Now, whoever bought it at that level multiplied their money times 36. So that's kind of like one of the, you're a younger investor. If you can do that for the next 20 years, you will have more money than you will need. And all right. So Sabir, ARK ETF. That's Kathy Woods, right? Let's take a look at that later. She gets a lot of flack, man. And we'll take a look. All right, looks good. Looks like some chatter between some of the attendees. Yeah, so this one here, Sabir, I would actually, assuming there's no market rotation from large caps to small caps. I don't know if you're responding to a question, but I actually am seeing that there is a rotation from big caps to smaller caps. All right, so the Walgreens CEO cannot afford living in Monaco in his 70s. Interesting. All right. So anything happened with Netflix? I don't know. Netflix is doing well. Doing well. Palantir dropped. Yeah, I want to take a look at Palantir. Let's look at that later. And then Carlos. Yeah, let's take a look at HIMS. I used it as an example earlier, Carlos, and it kind of showing how too expensive some stocks are getting. I'll take a look at it a little later. All right, let's jump into Pfizer. So Pfizer reported on February 4th, they had a good earnings. When you look at Pfizer, I encourage you to look at the last 2 quarters, because this revenue is growing really well. But previous quarters, when they were comparing these quarters to quarters that had all those COVID vaccines which were in that sales number. But now there's no compare to COVID related years. So now they're seeing that they're organically growing. They acquired some businesses that are really, really good. So I really like this growth. I'm very optimistic that Pfizer is going to be a stock that's going to double for me. They're a $146 billion market cap company. Just looking at the 5-year, at one point, this was a $59 stock down to 25. So if they can get back to those days, and if you look at the revenue, they're a good company. They're at 55 billion, and I think they're going to end up getting to 80 billion, 100 billion in the next couple of years. The revenue is at 63 billion. Forward PE is only 8.76. So I just showed you this. These guys are growing for 2 quarters, and the forward PE is 8.76. That is a screaming buy for me. And dividend is 6.64. So you get income while you wait for this stock to appreciate nicely. Year to date, still not working in 2025. For the 1 year, it's down 6%. With that dividend, you're breaking even, which is not good. But I think this stock could really start to work. So I'm sure a number of analysts cover it, and they think it's discounted by 23%. I agree with them. That's about the discount that I have on this stock. They are producing profits and cash flow. Before COVID, they were a really cash generating company. During the COVID years, they were generating massive cash. They have that cash on the balance sheet. They acquired businesses. So overall, I just think Pfizer is going to set up to really appreciate over the next couple of years. Merck, I'm not as impressed with. And boy, they can't catch any love, it seems. We look at Merck, it's down 33%. Year to date, it's down 14%. Over the 5-year, it's gone up a little bit. It really went up, and then it's really come down. This one here is not catching a lot of love. Its forward P is really low. Dividend is 3.79. So this is where like income investors can come get these awesome dividends out of these big pharma companies. It's a buy with a 40% discount. Thing about Merck, last time I saw it, see this growth doesn't excite me. It's okay, single digit, but I've got Pfizer at like 25 to 30% growth on a big number. That's exciting to me. So that's the horse that I'd rather ride, is a bigger, faster growing company. These guys here are steady eddies growing that top line revenue. Their net income expanded in the trailing 12 months in the last year. That looks good. And their free cash flow isn't reported for the last year, but they're a solid cash flow company. Every time I look at this business, it's like, hey, these guys offer you a good discount, good dividend, good valuable stock. It's not a bad stock to own. And you're picking it up at a discount, right? At some point, these healthcare companies are going to come back. Right now, the story that I think is hurting them is you have the new head of the health department for the U.S., Kennedy. He's kind of an anti-pharmaceutical kind of guy. So that may affect them. That's real. He may say, hey, we're not going to allow drugs for certain use cases. And that could really hurt a pharmaceutical company. So that is real. But we'll see how things play out. Hopefully Kennedy doesn't create too much damage. So that's Pfizer and Merck. My choice between those two is Pfizer, but you make your decision. So Bumble, man, these guys dropped. Investors dropped this like a hot potato, man, down 30%. Wow. Yeah, this one's got a lot of radiation to it. I don't think this is investable right now. So they guided lower, which was a problem. They're going to be contracting. They're already contracting. And I think the question that I want to answer for you, Sergio, is this worth buying if it's been sold off? And the answer is you're buying a sick business, a weak business, a business that's broken and needs to be fixed. So I would say that that's not the recipe for my success, because these broken businesses sometimes never get fixed and then they just keep spiraling down. So I would want to see evidence that they're being fixed, and you have to do your homework on Bumble. If you think it's getting fixed and they're going to start growing, this could be a huge winner, but it could continue to be a loser, and investors just pour it out of the stock. They're really concerned. They guided that they're going to lose, like $20 million of revenue. And that was, I don't know how many percentage points that was, but the trend is really bad for Bumble. It's like, hey, they're losing revenue. Is it because their competitors are better and consumers are moving away from the Bumble app? Could be. So I would not be touching Bumble. It's a bag of problems in my book. So symbol Sentinel-1. I think this is security, right? Cybersecurity. Yeah. I looked at this stock. Okay. And these guys over the 1 year down 21, year to date up 4%, 5 year down 34. So 7.42 billion, revenue is 770 million. So you're paying about 9 times revenue for the company. And forward P is 164. They're just about to start being profitable. To buy with a 27% discount. Now, cybersecurity is a crowded space. You got CrowdStrike, you got Palo Alto. I like Zscaler. There's also there's like a 6 to 8 horse race here. Sentinel-1 is trying to be competitive out there. There's no one dominant cybersecurity company out there. So these guys do have a little bit of free cash, so that looks good. But when I look at this, I prefer Zscaler, because Zscaler is a more known commodity, and I do believe that they are discounted. This is cybersecurity, same industry. It's 33 billion versus a smaller cap. They're growing. Man, my app is not getting it done today, man. What's going on? Really nice growth, really nice percentage growth. Sentinel-1, about the same growth, but a smaller number. Same percentage, smaller number. And the free cash flow is not proven, just like 1 year of free cash flow, where Zscaler has multiple years of expanding cash flow. So I think my investment in Zscaler is a better place for my capital. I think it's going to do well. Year to date, Zscaler is up 19%. This is a stock that I started buying into late 2024. It came out of the weekends, the community of paid investors that subscribe to my community, I guess, through YouTube. We look at industries and we looked at cybersecurity, and this is the one that came out on top because it was discounted, where CrowdStrike, Palo Alto, those others, their stock prices are really high. So it's not about, picking the one that has the highest stock price and that has the best history from a stock appreciation perspective. It's about which one is going to be worth far more than its current stock price. And in my opinion, Zscaler came out on top of that conversation. So that's why I started buying it. And if you want to attend those meetings, become a member. Then you can attend those meetings. If you want to see some of the tools that I use, become a member. That's how you get access to them. All right. So Sentinel-1 is okay, but I think it has risk. The risk is it's a small company. Their competitors can really go after them, and then their revenue would slow down, and then the valuations are going to really, really collapse. They're barely profitable, barely turning some free cash. The forecast is they are going, how many people analyze this company? 29 analysts. So there's analysts all over this. It's going to continue to grow according to the analysts. So that's very good. But the profitability is not all that great. It is expanding quickly, so that's good. So the PE is going to go from, geez, that's a high PE. Eventually, it's going to get down to the 20s. And Zscaler, is going to lower PE. It's still kind of a high PE, but that's where that one's at. All right, so that is SentinelOne. Looks good, right industry. Just do your homework because this one hasn't been an absolute winner. They're not completely profitable. And if they have a bad quarter or two, their stock's really going to suffer. Okay. And a lot of competition out there. They got to compete against, like I mentioned, there's 6 to 10 companies they have to compete with. All right. So that's S. Supermicro. So Supermicro is up 97%. Incredible. And that's because they're down 25%, which isn't as bad as I thought. But I mean, they were sky high March 4th, 2024. So why isn't that in the 1 year? Oh, I guess it's right here. Yeah. So Supermicro is a hardware producer and they don't make a lot of money. They're catching a lot of attention because they do have high performance computers. They buy really expensive GPUs from NVIDIA. They buy really expensive components and put together these high performance computers, but their margins aren't very good. This is a $35 billion market cap company. And when we look at their fundamentals, specifically like their margins, although they've been growing really well, they were really small, growing really well. Let's take a look at their margins. So gross margin, 14%. That's not very good. They do have a good profit, decent profit margin, 8%. But this is why hardware companies aren't worth much, because they don't have margins. They have a lot of competition. Who's competing against Supermicro is Dell, Hewlett Packard Enterprise. You've got like 20 competitors, and they're also competing against the cloud because a lot of these public cloud companies like AWS, Microsoft Azure, they're actually configuring their own servers, and they compete against Supermicro. So this is just a company that had just a stupendous rise and became a target for short sellers. And I made money on Supermicro by shorting the stock because I just thought this is not sustainable. This is a hardware company. So I started shorting them. I don't know if I shorted them here or somewhere around here. Then I sold them like around here. And I made like 52% just very quickly. And I got out. And then it went further down. From here to here, yeah, the stock's really risen. But this is an ugly chart, man. At some point, it's going to revert back to $20 a share, maybe 15. And I'd rather just buy into something that's going to be worth more money in the future. This is a short-term gain, right? Here, you see this chart just for the 1 year. And once we compare to this number, it's down 49% from the peak. And I just don't see how they're going to be able to sustain this. So Supermicro, man, what a journey this is taking investors. If you bought here, you're like flying high. If you stayed too long for the party, you lost money. If you still stuck it out, you're still doing okay if you bought here. So you're expecting the company is still going to fly up. So that is Supermicro. All right. Humming along. TDD. Let's go over TDD. I don't even know what that is. TD. Excuse me. Trade Desk. Yeah, this one I think collapsed, didn't it? Like it's not doing well. Yeah. Down 34%. I think this one here, our friends at Robinhood and other companies are, but what's the deal with their revenue growth? That looks pretty good. What did the market not like? This is good growth. Thought I was going to see like some red numbers. That looks pretty good. So earnings per share is expanding. That looks good. Free cash flow, 641. Looks good. Margins are really high. Looks great. So these fundamentals look great. Balance sheet. They have $2 billion of cash, only $300 million of debt. They got plenty of cash. So what did the market not like? February 12th was when they announced. We're at the 19th, so try to go back in the time machine here. So I don't know why the stock sold off as much as it did. And it's including the latest numbers. I'm seeing revenue growth. I'm seeing like a prosperous business. So what happened? Like, what does the market not like? I mean, it dropped off a cliff. Is there like some kind of like there's some big problem? What's the big problem with Trade Desk? These guys aren't going to let me see this probably. So revenue was below consensus by 17 million. Okay. That could cause stock to sell off of 30%. They missed revenues for the first time in the past 33 quarters. Okay. It seems like the sell-off is overdone. This seems like an opportunity to me. I'm seeing solid fundamentals. Maybe the market overreacted on this one. Their forward P is 42. And I'm seeing like the last quarter, they grew by 22%. Okay. They're really profitable. What's the cash generation? So free cash flow, 179. Yeah, it's going to be hard to get to this market cap with that cash. They don't do a lot of cash, so I can't get beyond like 10 billion in value based on their free cash flow. So maybe that's what's alarming everybody is where's the cash? You're doing 2.44 billion. You're doing about 8% free cash flow percentage off that revenue. It's not bad, but it's not great. And they do have a pretty sizable market cap. The stock had been going up for a long time. It went from $17 a share up to 139, and the party's over. It's time to pay the piper. Now it's coming down to its intrinsic value. These guys are valuing the company based on earnings per share. If you study the cash flow, I cannot get you above a $10 billion valuation based on cash flow. There's just not enough cash coming out of this business. If you look at Robinhood, it does way better on cash. Coinbase, way better on cash. So these guys are not generating enough cash. So it is a total pass for me. Looks like these guys are going to tumble and it'll be a while before they start to rally, in my opinion. So TDD. So So ARK, what are they holding? Tesla, Roku, Coinbase, Palantir, Roblox. So Roblox hasn't done well. I don't know about how Roku's doing. I know Coinbase has done well. Tesla's done well. Palantir's done great. Robinhood's done great. I own Robinhood. Shopify's done good. Meta's done great. Man, that's a lot of stocks. Yeah. So the thing about, like our innovation is everything lines up for them like every 10 years. And then they're like, announcing their victory. Like, man, see how smart we are. And then the other 8 to 9 years, they're terrible. So it's like, wait, you can't be good 1 or 2 years out of 10 and claim to be like really good. So I'm not a buyer. I think once in a while they claim victory, but most of the time they're underperforming the rest of the market. So that is ARK. So we're going to look at HIMS. What happened at HIMS? Wow, 17%. This thing's gone crazy. This is another reason why I'm nervous. This is insane. PE 154, Ford PE 128. These guys don't even have patents. They're doing compounds, and they could be deemed. The government can help have them stop because they could be violating patents, or those compounds. What if they become like harmful to people? They are growing well, but they're small. They're tiny. What's their? So 1 billion. So that's not too bad. I guess they're still a small cap. Whoop. And yeah, the HIMS story's getting pretty wild. Analysts think it's, priced 56% too high. I think they're priced way too high. I don't think it's going to end well. I think this stock's going to come back to 20, and we'll see when that happens. How many shorts are there? Yeah, 26% of shares are shorted. This one is not going to end well. And I know short sellers, you're like, man, I don't like short sellers. Bunch of jerks. I get that. But this is not going to stay at $70 a share. It's going to come down. And short sellers are telling you that. And if you want to ride this, if you want to buy now expecting that HIMS is going to go up even higher, more power to you, because a lot of people are doing it. But at some point, it's going to stop. And when the music stops, it's going to come down. It's going to crash down to 20. We'll see when that happens. I might need to go short on HIMS. Put some money on this horse to lose. All right, so we got through the list. Let's take a look at, see if there's any new comments I need to respond to. Man, we got a lot of people on the live stream. Thanks for joining, everybody. All right, so we talked about Palantir. Palantir dropped 15% today. I'm short Palantir. I'm already short Palantir. So if there's a lot of bad news around the government. Oh, yeah. Did we look at Palantir? I don't think we've looked at Palantir yet, right? Okay, let's take a look. So Palantir, the new administration is really trying to reduce costs at the federal government level. And it was two things are going on that's causing investors to really re-examine Palantir. One is the CEO is selling a lot of stock. He's selling like $1.2 billion of stock. And two, the federal government, the Pentagon, there's a spending freeze. So they're going to spend a lot of money on Palantir, and that's a pretty good segment of their revenue. So when we look at their revenue, it's not incredible revenue. And now they're going to deal with the headwind of, hey, the federal government's not going to spend as much money with you as maybe you thought. So if their revenue starts coming down, and again, this is not incredible revenue growth, it's just okay. I can show you 100 companies that are doing better from a percentage perspective. Then maybe this stock, which is priced more than 100 times revenue, is really overpriced. Could be, maybe. It's the stock's really, really climbed. Congratulations if you own the stock. But this party is going to come to an end, and there's going to be a lot of people crying when it comes back down to 40, and it's going to be a rough ride. We'll see. The market can keep the retail market can continue to push the stock up. Like HIMS, we just saw that stock rally. I think investors are trying to find the next NVIDIA that just rose up in incredible feats. But I invest in fundamentals. I have to know that the company makes a lot of money, creates a lot of free cash, generates a lot of value. Then I invest. These stocks, they have some pieces to them that look really good, but they just get overpriced, and Palantir is in that category. So we'll see how it ends, man. It's going to end pretty bloody, in my opinion. All right. So Occidental. So Occidental's in the energy complex. How has your stock been doing? Up 3%. Now this thing was like rocking a couple years ago. Like Warren Buffett looked like a genius, right? Around this time. But since, and you can say this about most energy stocks, from this point, forward, it hasn't done much. And I don't know that that's going to change. Oil prices are not doing all that great. Oil prices are pretty tamed. They're like low 70s and not going anywhere. At that rate, these stocks are not going to rally. So Occidental is doing okay. I should say is underperforming the market drastically over the 5-year, 22% rate of return. That's no good. So Warren Buffett's a big owner of Occidental. I don't know. I'm selling some of my Chevron stocks because I just don't see a bright future for energy. It's pretty, for 2 years, these things have just done nothing. It's been underperforming. And I don't see how they're going to perform better for the rest of 2025. So that's Oxy. Trade Desk. All right, Tristan coming in with some good information. Possible violations of federal securities law. Ooh, that's a big problem. That's why the stock sold off. So good luck with that. Good luck with that, Trade Desk. All right. And came out 2 days ago. Thanks so much, Tristan. Appreciate it. CFLT. Confluent. So Confluent operates data streaming platform in the US and internationally. So it allows customers to connect their application systems, data layers. That's interesting. All right, cool. And they are located in Mountain View, California. And over the 1 year, not doing much. Over the 5-year, same story. 11 billion in market cap. They're losing a lot of money. Oof. They are growing, but they're just losing money. So their gross margins are okay, but their operating margins are really bad. and they are cash positive now. So that looks interesting. I mean, these guys need to get on a good run of like get profitable. They're going to be profitable. I mean, this is a little early. Their gross margins are good. So gross margins are good. They just have a lot of cost in there. Maybe they have a lot of engineering cost. Now they have some free cash flow. So these guys might be entering a real good time to consider these guys. And here's why I say that is if you're in early on a small cap like this, they get profitable. This PE starts to get very rational and you're in early, and then other investors join you, you're going to make a lot of money. So this is a good watch stock. And when did they announce? February 11th. So they just announced. But this one here, looking at it for the next 4 quarters, if they keep getting stronger, bigger, more profitable, this is a good buy for me. Just buying it after I see evidence that, hey, they're on their way. And this is going to turn from 11 billion market cap company to something bigger. So they're showing signs that they may be on that path, but just 1 quarter, or actually 1 year. Let's look at the quarterly. So the revenue's there. So they're still negative there. Free cash flow for 3 consecutive quarters, positive free cash flow, and it's expanding. And these companies, when they get their size and scale, that's when they start cranking out free cash. So as they get bigger, this cash flow is going to get bigger as well. So this is a good one to watch. But you got to watch it for a while, like 2-3 earnings releases. If these numbers keep getting better, man, I'm going to buy. So I had never heard of this company. Thanks for bringing it up. This is Confluent. Yeah, this is a good one. And again, like you're in early, but I mean, this isn't going to be like a name that's going to be, I think, found out very fast. And you can see that it still has a lot of volatility. It is nice, 18%. Looks like when they announced, market really liked what they saw. It's now coming down. So maybe 1 more quarter, 2 quarters, if they see the right, if I see the right fundamentals, might be the right time for me to buy. So good one. Thanks for bringing it up. All right. So let's wrap things up. We've been going for about 1 hour and 10 minutes. So let's see what tomorrow has. I think tomorrow is going to be pretty interesting. A lot of big companies are going to announce. So we will see what Walmart has to say. I'm going to be live streaming again tomorrow, same time in the evening. So I'll have plenty to talk about here. Of course, I'll go over stocks that you guys want to talk about, but there might be some big stories coming out of these earnings. Walmart being the biggest. Alibaba's been cranking, doing really well. Booking, I'm expecting they're going to have a good quarter. Their guidance might be a little light because Airbnb had light guidance. And Booking may follow suit. Mercado Libre, really curious to see that one. New Holdings, really curious to see that one. So there should be a lot of interesting stories to see tomorrow. All right. So everybody, thanks for tuning in. This was a cool live stream. Thanks for bringing it today. And thanks for bringing those stock symbols to look at. And I appreciate you guys. And that is it for tonight, guys. Have a nice evening. Good luck with your trades tomorrow. We'll see you.